So before you send in the order to sell an option, which could come in the form of things like selling a credit spread or a covered call, a cash secure put, short strangle, doesn't matter, but before you make that trade, there are a few requirements that must be met in order for that to actually be a good trade. So basically in this video, I'll be giving you my personal option selling checklist, so to speak, that contains 3 main criteria, which like I said, must all be present before you sell an option. Otherwise, you'll be putting yourself at a significant disadvantage. And these 3 criteria involve taking a look at the implied volatility for a stock, and more specifically, comparing the current implied volatility to the past 12 months or so. We'll also take a look at the liquidity of the contracts you are considering to sell. And then finally in this video, we'll take a look at the concept of diversification, both in terms of the strategies you're using as well as the stocks you are trading, to then see if the trade you want to make right now is actually a good fit for your portfolio. Now, as always, before we dive in here, in case you are brand new to the channel, my name is Scott Reese, and I'm here to help you learn how to trade, invest, and master your finances so you can apply that knowledge in the real world and multiply your money. And in case you want to see more trading or investing content after watching this video, you can also find me on SKILLSHARE as well, where you can take my very in-depth classes on options trading or stock market investing. And I provided some links to some of the introductory courses of mine in the description of this video below. So be sure to check them out. And when you sign up for SKILLSHARE using any of those links, you'll get a full 1-month free trial. All right, so with that being said, at this point, we're now going to jump on over to thinkorswim here, and we'll get things started. All right, so for my example in this video here, we're going to focus on AMD. This is Advanced Micro Devices. I'm sure you've heard of it. And basically, this company is involved in the production of computer chips. Now, the reason why I've chosen this stock is because it is a perfect example of the kind of stock that you would want to sell options on, as you'll see here throughout the video. And so the first thing that you want to look at before selling an option on some stock, basically the first item on this checklist, is going to be you want to look at the implied volatility of the stock. Now, there are actually a few things to mention about the implied volatility. And first of all, what is implied volatility, in case you're not aware? So the implied volatility for any stock is basically a measurement of the uncertainty about that stock's future. And more technically speaking, it can be quantified as a percentage, and it basically corresponds to a future expected price range at some point in the future, typically 1 year out from today. Now, the important thing to understand here, though, is that the implied volatility for any stock is baked into the prices of option contracts, and specifically with higher implied volatility and therefore greater uncertainty about that stock's future, the higher the option prices will also be. And then conversely, with lower implied volatility and therefore more certainty about the stock's future, the less the option prices will be. So with that in mind, and also thinking about the purpose of selling an option, right? The purpose is to collect a credit up front, and then you want to obviously keep as much of that credit as possible by the expiration date. So therefore, it only makes sense to collect as large of a credit as possible, right? Because with a larger credit, that simply means bigger profits. So regarding the implied volatility for the stock that you're looking at, there are 2 very important things that you want to make sure are present. Number 1, you want to make sure that the implied volatility is decently high just by itself. So in my opinion, that means an implied volatility above 30 or 40%. And then also number 2 here, you want to make sure the implied volatility for that stock is higher than usual for that stock. So taking a look at the AMD charts here, this one up top is the price action chart showing you the daily price movements for AMD over the past 1 year. And then down below at the bottom, this chart is showing you the implied volatility for AMD also over that same past year. So right now, the current value of implied volatility for AMD is at 56.17%. That's pretty darn good. So like I said, you want to make sure the implied volatility itself is decently high, above 30 or 40%. Because once you start getting below 30 or 40%, the prices of the options become very, very cheap and typically, in my opinion, are not worth selling. Now, regarding my second point about implied volatility, namely that you want to make sure the implied volatility right now is still higher than usual for that particular stock. Well, as you can see with this chart, the implied volatility for AMD definitely does fluctuate quite a bit, right? Especially back in January, for example, when this massive sell-off was occurring, there obviously, as a result of this, was a lot of fear and uncertainty about what's going to happen with AMD in the future. So therefore, during this time period, we saw a massive spike in the implied volatility all the way up to about 80%. So especially at this time, the prices for AMD options were very, very expensive. And therefore, as an option seller, if, for example, you were selling puts on AMD at around this point, then not only did you get the directional move correct with the stock thereafter, but the profits you made on this trade would have been quite substantial. Again, because the IV for AMD was so high at the time. So bottom line, this point would have been an excellent time to sell options on AMD. And then over here, when the implied volatility was down to only 28%, this would have been a very bad time. Now also take note of these two indicators right here on this chart, IV rank and IV percentile. Now not every trading platform has these two indicators. Obviously thinkorswim has it, although you will have to add it in here. But basically what these two indicators do will show you in just one number basically how high or low the current value of implied volatility for AMD is right now compared to the past 1 year. Right, so again, the IV right now is 56%, but is that typically high or typically low for AMD? And that's the question that these two indicators will answer. So the IV rank, for example, will compare the current value of implied volatility to the lowest point the IV has been in the past 1 year. So in this chart, that would be right around here, back in June of 2021. And it will also compare it to the highest point in the past 1 year, so right there. So therefore, with an IV rank of 55%, and keep in mind, this indicator will always be between 0 and 100, this means the IV right now for AMD is basically right in between the low and the high of the past 1 year. And you can also confirm that just by taking a visual look at this chart here. So again, the current value is right there, and yeah, it's definitely pretty much right in between the high and the low over the past 12 months. So that's definitely not bad, but still not amazing. But sometimes this IV rank indicator can be skewed a bit if the high or the low over the past year was at an extreme point. So that's why I also do look at the IV percentile as well. Because this one here will also take a look at the current value of implied volatility, but compare it to every single day in the past 12 months. And so right now, 75% of the days in the past 1 year had an implied volatility level for AMD less than where it is right now of 56%. And again, you can pretty easily confirm that just by taking a look at this chart as well. So following this gray line here all the way back through this chart, you can definitely see that most of the points on this chart were under 56%. So ultimately here, I just wanted to show you a couple different ways you can confirm whether or not the current level of implied volatility is high or low for that particular stock. So even if your trading platform does not have the IV rank or IV percentile indicators, chances are it will have a simple implied volatility graph that you can look at. And in that way, you can still see just visually, is the current level of implied volatility higher than usual for that particular stock. And again, the whole point of doing this kind of analysis is to see which stocks and at which points in time are the most advantageous for option selling, right? Because like I mentioned earlier, your profits as an option seller are directly correlated to the credits that you are receiving when selling these options. So therefore, it's to your advantage to find the stocks with the most expensive options to sell. And that's mostly going to be based on the implied volatility. Okay, and so now if the stock that you're looking at does pass that first item on your checklist, high implied volatility, then the second item on that list is going to be option liquidity. And specifically, the liquidity of any asset refers to how actively traded that asset is. And this is very important because the more actively traded a particular stock, or in this case, an option is, that means it's going to be very easy to get in and out of your trades, and also at very, very good prices. And so back to AMD here, let's now come over to the trade tab and take a look at the option chain. And for the sake of example, let's go into the April monthly expiration. These options have 19 days left to go. And when it comes to assessing the liquidity of an options market, you want to take a look at the volume and open interest of the contracts. And the volume here is simply the number of contracts that were traded in the most recent trading day. And the open interest, this represents the number of current open contracts, or the number of contracts that have yet to be settled. And so in particular, the most important thing is taking a look at the volume and open interest for the near at the money options, right? And that's because these are the contracts that are most actively traded anyways. There's really not a point to be trading the contracts that are super, super far out of the money, way out here, or the contracts that are super far in the money, right? Again, for any stock, the most actively traded contracts are right around at the money. And so take a look, for example, at these call options. The volume, for instance, for these contracts are pretty much all in the thousands. That's very, very good. So in this case here, the 125 strike call option There were over 6,000 of these contracts traded in the most recent trading day, which was, at the time I'm recording this video, on Friday. Moreover, the open interest for this contract is over 15,000. And pretty much the same thing can be found for all the other contracts. Very high volume and very high open interest. And ultimately, what this all translates to is very tight bid-ask prices, right? So as you can see here, these are the bid prices for all these contracts. And in this column, these are all the ask prices. And typically, most trades get executed with prices that are basically right in between the bid and the ask. So again, in the case of this 125 strike call option, if I were to try to sell it, I would choose a price right in between here at 335. Now, like I said, most of the time you probably will get filled right in between the bid and the ask, but sometimes you won't, and you will have to adjust your price a little bit. So therefore, if the bid and the ask prices are very narrow or very tight, you will not have to change your price by much to eventually get filled, and that's a good thing. Moreover, with high volume and open interest, that means there are a lot of people out there wanting to trade these contracts. So it's going to be very easy to find somebody to take the other side of your trade. Otherwise, with very bad liquidity, very low volume, low open interest, and therefore very wide bid-ask prices, that's going to make it very difficult to get in and out of your trades, and you will typically not get filled at very good prices. Right? For example, by comparison, let's go to YUM. This is Yum Brands. And it's basically the exact same price as AMD, but take a look at the volume and open interest on these call options. There's basically no trading activity happening here whatsoever. And as a result, now take a look at the bid-ask prices. They're all super, super wide. So for example, with this option here, this is the 126 strike call option. The bid price is 35 cents, but the asking price is $1.30. So we have a difference here of almost $1 full. And consequently, it's going to be very hard to find the right price to actually get filled at with your order. And as an option seller, you might have to come down in price by a huge amount to find a buyer willing to pay for that contract. So ultimately here, as a general guideline, take a look at the volume and open interest for the option cycle that you're looking at, and make sure the volume and open interest are at least in the hundreds. Right? You want to see at least a few hundred contracts being traded for most of the near at the money options, and same thing with the open interest, a few hundred at least. And then also, of course, then take a look at the bid-ask prices. If the difference is super, super wide, then stay away. But if they're only a few pennies wide, then that's definitely a very good sign. And then finally in this video, the third item on your checklist should be, is this potential trade a good fit for your portfolio? And basically the objective here is to have a well-diversified portfolio. And there are two different ways you can diversify a portfolio, and I recommend you do both. You can diversify in regards to the strategy types that you're using, and also with the actual underlying stocks that you're trading, specifically the sector or the industry that those stocks reside in. So for example, what you don't want to do, let's come back to AMD real quick. So given that AMD is in the tech industry, what you don't want to do is sell, for example, a put credit spread on AMD because you might be bullish on the stock, and then sell a short put on, for example, Apple, and then sell another put credit spread on Nvidia, right? Because all three of those trades are bullish trades. They're all betting on the same direction of those stocks. And then also, those stocks are all in the same tech industry. AMD, Apple, and Nvidia are therefore going to move very similar to each other. And as a result, if something were to happen badly to the tech industry in general, which if we now come back to the charts and go to NDX, this is the NASDAQ index. At the time I'm recording this video, the NASDAQ, which is mostly tech stocks, has undergone a massive, massive sell-off. So again, if you placed a bullish trade on AMD, then obviously with tech stocks getting hit the hardest in recent times, that trade is obviously not going to be doing well. Same thing with Nvidia, NVDA, very similar chart. And then also taking a look at Apple, AAPL, again, very similar story. So bottom line here, if you do not well diversify your portfolio, both in terms of the strategies that you're using and also the stocks that you're trading, then you will run the risk of losing a lot of money when something bad happens to the particular sector that you are mostly trading. So it's definitely fine to have multiple positions on in the same sector or industry, but at the very least, diversify your strategies. So basically, perhaps sell some put credit spreads on Apple or AMD, and then also sell a call credit spread or some kind of bearish position on Nvidia. And then, of course, also have different positions on in different sectors and industries. Perhaps make a trade on some banking stock and a different trade on a stock that's in the industrial sector, so perhaps an airline. So the bottom line here is the more well diversified your portfolio is across different strategy types and different sectors and industries, the more stable your portfolio is also going to be. So basically, there's going to be way fewer crazy swings in your account value. And so with that being said, that's going to do it for this video. I hope you enjoyed it, and please let me know your thoughts or if you have questions in the comment section below. And don't forget, if you want to take some very in-depth classes on options trading or stock market investing, then check out my SKILLSHARE courses. Links in the description of this video. And finally, if you enjoyed this video, then please give it a thumbs up, drop a comment, and subscribe to my YouTube channel. I drop new videos every single week, and you don't want to miss out. So thanks again for watching, and I'll see you next time.